Hey traders, this is Blake Morrow with Traders Summit, and I have with me Ken Morrison, founder of Morrison on the Markets. How you doing, Ken? Good to see you again.
Thanks a lot for having me again, Blake. We had a good conversation about 6 or 7 weeks ago and highlighted some things about oil then, and we'll talk about it today. So
Yeah, I want to say a couple months ago when we talked about crude originally, you had mentioned that crude wasn't going to break 85 bucks and near term. And we bounced off of $85. I think we sat in a range between $85, $95 a barrel for a good several weeks before we finally broke down. But crude since then has turned around and has been rallying a little bit. So I'm interested to get your point of view about crude oil and about the markets. What other markets did you want to hit today?
we're going to talk about wheat and corn. A couple of things going on there specific to today. They're trying to break out of some 2 or 3 month trading ranges to the upside. We've got another USDA monthly forecast coming up on Wednesday. So I thought it'd be a good time to kind of hit those briefly as well to show what they're doing today specifically.
Sounds great. Well, I'm going to go ahead and pull up the chart that you had brought. But before I do that, I just want to say, if you guys and gals like what Ken does and the information he's bringing to you today, make sure you give him a thumbs up, subscribe to the channel so you don't miss any of this exclusive content. And Ken, we're going to go ahead and get, let me go ahead and share the screen so you can actually see, everybody can see what you're talking about. And here it is. Here's the recent chart in crude. So can you tell us what we're looking at here?
Yeah, I've got a couple of charts, daily charts of the crude oil contract. This happens to be the daily nearest contract over the last 9 months since January. And I wanted to show that. I'll show the daily contract of the November contract here in a moment. But the reason I like this chart and wanted to show this one specifically, oil has been in backwardation for really the entire year, varying between if you go out a couple of months, varying between a backwardation of about $8 at its high, premium to a couple of forward months, and it got down to about $1.70 or so in September. And so it's been in backwardation. But what I like about this particular chart and wanted to show it for that reason is it shows the downtrend line that we are still kind of now bumping up against. And that downtrend line off of the July high, hitting another point there in late August on the rally. And we're right back there again in the front month contract. And so I wanted to show that, but I also wanted to point out that here's a contract and here's a market that is continually having lower highs. And I think that that's also an important facet of this chart too. And so we're right there. And as my wife Helene likes to point out, it's not a breakout through the downtrend line if you have to squint to see it. And you kind of have to squint to see this breakout. And so that's the point that I would leave on this particular chart. We can move on to the, and as you say, we did break down there briefly. This is the current front month contract of the November contract. And I think this is the real crux of where I would line up in terms of what my expectations are for oil. It's got the potential certainly to build out that right shoulder of what now appears to be a head and shoulders bottom. And as you can see on the left shoulder, we were in consolidation as you and I talked earlier back in August. We were in consolidation between an 85 and 95 range for quite some time, really throughout the month of August, and even for a brief period, we stayed within that range in September.
Right.
But where I see it now is a couple of things. It's got certainly the high potential, in my opinion, to stay within this right shoulder pattern, which would again bring us back to an 85 to 95 trading range of the current contract, and I would believe also of the front month contract as we move forward. I would also point out that 50% retracement from the June high to the September low brings us back to $94.57. And so you've got a couple of things lining up here to suggest to me that $95 is going to be a pretty tough nut to crack through on the upside. You've got that right shoulder pattern, and you've got a 50% retracement point. And so in resistance coming across from those July and August highs. So I'm pretty firmly still in that $85 to $95 trading range. I guess you can build a case that on a pullback, we could find some support at 90. I wouldn't trust that support at 90 all that much, but I would point that out as a potential support level on any pullback. I'm a little bit surprised, given the weekend military actions in Ukraine and Crimea. I'm a little surprised that we've not seen better follow through on the upside from oil today. And again, I guess that kind of reinforces my notion that getting through 95 looks like it's going to be a tough challenge.
Oh, but and plus with the OPEC cuts from last week, right?
That's right. Yeah.
Yeah.
Yeah. And I'll say a couple of words about that. If you sort through basically the notion that the cut was from the allocation level and not relative to the production levels, I'll go with the notion that's been put out there that the effective production cut is about 900,000 barrels a day. That OPEC cut last week relative to the level of production that they have been producing. They've been underproducing the quota for 2 or 3 months. And so, while their benchmark of allocations and cuts may be relative to the quota, you really have to look at what they've been producing to sort out really what the effect of the cut was. And so, that's where I'll leave that. But in addition to that, I would also say that in terms of demand, we're going into a season, especially November through February, we're going into a season, at least in the US, when demand is historically seasonally lower than it has been in the previous 2 or 3 months. For example, over the last 13 years, in terms of products supplied during November, we've been down relative to the October product supplied all 13 years in the US. And most of those declines in November relative to October were roughly 3 to 5% lower. And so,
how does that usually translate to price? As far as demand may be lower, but isn't the market already factoring that in?
I'm sure the market is a discounting mechanism. So I would say the answer to your question is yes. I've not looked at it relative to the price action. But I will say that it's pretty strong evidence, especially the low ebb in oil demand in the US is usually in the month of February. So I guess all my point is, I think there's a little bit too much to do over a little cut in terms of OPEC's actions last week. So that's
understood.
That's a fundamental viewpoint, and I would stay with my views on the chart relative to the fundamentals. But it all comes back to me to say, let's see, especially in an environment when a lot of people are still talking about the potential for a recession. And so, how big really is 900,000 barrels loss of production in an environment where most people, including the market and the oil charts reflecting that probably, most people think we're going to have a softer economy going forward. And so, let's see how it all sorts out.
Well, it makes sense. So you brought a chart of diesel futures. Why did you bring us that today?
Yeah, let's flip over to that. As you recall, when we talked back in August,
correct,
I said I would not get bearish below $85 unless I saw the refining margins for products take a real hit from where they were then. And I think refining margins at that point in time were about $40 a barrel. Okay, they did soften. They softened to about $26 a barrel, which coincided with the low in crude oil in September, but they've now recovered. And I would say I'm using this chart of diesel to point out that it's actually been the diesel product market that's led the rally in crude oil. And so I would have the same view. I would have the same view that as long as refining margins are this strong, I believe that there's going to be support for oil above $85 a barrel.
That makes sense. And would you let me ask you this? So if you're looking at diesel futures, if they actually break out, is that going to suggest that crude might actually get another leg higher?
It could
Okay.
very well mean that. However, you know, the diesel refining margin is its widest level relative to gasoline that it's been since June. So basically, when you're producing 2 barrels of gasoline and 1 barrel of diesel, it basically says there's a big incentive to produce diesel, but in order to get there, you've got to produce gasoline. And so I think the refining margins for gasoline will continue to lag diesel big time.
Okay.
Which will keep a lid on gasoline prices. But I look at this chart and I look at refining margins for diesel, and to me, this tells me this is a proxy for where inflation is likely to stay for a while. It takes diesel fuel to move just about anything you can imagine in this country by way of demand for diesel fuel. And so if you've got diesel prices this high, you're not going to see easing in terms of transportation cost for most things for a while. And so I like to show this chart because it not only tells us where diesel prices are and have been, but it also tells us, you know, price of fuel to transport goods, stuff, is going to remain high for a while. And that to me spells sticky inflation for a while.
Wow. Okay. And the next chart that you brought is also diesel futures. Is that correct?
I think so. Yeah. It's the spread. This is the spread between gasoline and diesel. Diesel being the premium over gasoline. And so again, that $56 a barrel spread, which is $1.33 a gallon for diesel, is the futures premium of diesel over gasoline. And as you can see, that has moved from a $30 premium low in September to currently $56 a barrel, diesel over gasoline. And so again, the coinciding with the low in September crude was also the low in that spread between diesel and gasoline.
Huh, that makes sense. So, but let's shift gears over to wheat, because wheat has been building this really nice base for like weeks. Is that correct?
Yes, that is correct. Actually, months.
Okay, here we go.
This is actually the hard red winter wheat contract. It's the largest produced class of wheat in the U.S. Relative to soft red winter wheat and hard red spring wheat. But this is the wheat that will actually compete with Russian and Ukrainian wheat. And so I chose the hard red wheat contract to reflect the notion that it is, if the U.S. is called upon to supply that quality of wheat to the world market, then the hard red winter wheat is likely to be that be the most effective.
And that technical breakout looks pretty scary for bears, I guess.
You don't have to squint to see that.
No, not at all. Not at all. So how are you forecasting wheat? I mean, obviously it looks pretty bullish here, but are you expecting much higher prices in the months to come?
Well, this is where it gets interesting, Blake. On September 30th, 10 days ago, the USDA issued its final production estimate for wheat in the U.S. that production number fell 130 million bushel relative to their prior estimate, which shocked everybody. The entire consensus was that there would be very little change in wheat production. Okay, so keeping in mind that September 1 stocks for wheat, or keep in mind that production of wheat, the final estimate was down 130 million bushel relative to expectations. But they also issued a September 1st wheat stocks for the U.S. Wheat stocks for the U.S. happen to be unchanged from where they were a year ago. Now, you first say, well, wait a minute, production was down 130 million, so how can stocks be unchanged relative to expectations? Well, it occurred because the price of wheat has gotten so high that it's too expensive to feed. It's also too expensive to reach a lot of export markets relative to competing wheat around the world. And so the bottom line is wheat prices are already at levels that are rationing U.S. demand, domestic feed, and as well, export sales are lagging the forecast because, again, relative to alternative markets, the U.S. wheat is not competitive to many more markets than simply our nearby neighbors. And so that's where it gets interesting for the wheat market. What I anticipate to happen on Wednesday is the USDA, on the basis of what the September 1 stocks implied about wheat demand for feed in the first quarter of the crop year, it implied that they should take nearly all estimated demand for wheat for feed out of the forecast. In other words, wheat for feed in the U.S. should essentially go to zero for the crop year. So, and that's basically what the September 1 stocks told us, is that it is rationed feed demand. And so it's going to be interesting to see how the market, if USDA goes the way that I'm saying they will likely go, it's going to be interesting to see if this breakout actually holds. That would be my message for the wheat market come Wednesday.
Wow.
In my view, it's going to be from these prices. I think we've gotten a little bit ahead of ourselves on the wheat market. Okay.
Well, all right. Well, before we jump into corn, I have to mention this just because she's your wife. We have a Trader Summit event from October 21st to 23rd, and your wife, she's going to be one of our speakers, and it's going to be are you going to be listening into her?
Well, I will certainly be listening in, probably in another room, so I don't make any noises and screw her up. But yeah, absolutely, she's looking forward to it.
Awesome. Well, hey, guys and gals, just remember it is free to actually register on our Trader Summit site, and there's going to be thousands of traders. We have a lot of great speakers, and two lucky registrants are going to win unlocked iPhone 14s. Those are given by our sponsor 8cap. So make sure you guys register. And I know Ken, you better register just so you can get a phone.
Yeah, my wife says I need a new phone. Helene says I need a new phone.
Well, there you go. Maybe you'll win. So let's move it over to corn, because you have a kind of a similar chart here in corn. And what are you seeing with corn in this move that we're seeing?
Yeah, I think corn is trading off the issue in wheat today a bit. As we came on the air, it's actually dipped below that $7 mark. This would have been the fifth test of the $7 level over the last, let's say, month. And corn has had a struggle holding these rallies, despite the fact that the supply in the U.S. corn market continues to decline. But again, that gets us back to a demand issue, because as supply dwindles, so does demand is rationed. And so what this chart shows me is the downtrend resistance line off of the May and the June highs comes in right at $7. And so once again, for the fifth time in about a month, we're right back to $7. But as I said a moment ago before we came on the air, it's not holding that $7 level.
Yeah.
So In fact, to be totally upfront here, I shorted corn today above $7 because that's my conviction, and it's similar going into the Wednesday report. It's similar to where I am on wheat. Again, demand is not living up to the forecasted expectations. There are other more competitive markets, namely Brazil, to speak of one. U.S. corn for export has been about a $35 ton premium to Brazilian offers. And so we're rationing demand already at these prices. And I think regardless of what supply forecasts are on Wednesday, I look for some big cuts in demand to offset any supply issues.
That's interesting, and so this would feed into maybe more disinflationary pressures in the economy. Would you agree with that?
What I see this doing is rationing and discouraging livestock feeding. The livestock margins are going to be very difficult, and so that would be one area. I think we've seen, for example, the beef herd decline in recent months, and corn at these levels without an offsetting improvement in beef prices are simply going to discourage producers from expanding the herd. So that's one offset that I see.
That's interesting. I love the commodity markets, but what I love more, Ken, is the way you put it all together for those of us in the Trader Summit community. So I want to say, if you guys and gals are watching Ken at home, give him a big thumbs up. Make sure you check him out. And matter of fact, Ken, how do people check you out? Because I've been following you for almost a decade, maybe. But how do people that, if they don't know about you, how do they follow your work?
Well, I'm on Twitter at Morrison Markets, MorrisonMKTS. So at Morrison Markets. And then my website is morrisononthemarkets.com.
Awesome. Well,
I write a 5-day, I write a daily newsletter that goes out to subscribers, and they can sign up for a 15-day free trial to check it out.
What I love about what you do as well with your newsletter, and because of your very vast experience in the commodities market, probably since you actually started in the markets, is that correct?
I started in 1976 with Cargill as a grain origination person in Omaha, Nebraska, and several stops later found me in Singapore and in China. So.
I might have been sucking my thumb right around that time. So, but you know what? Experience matters in this type of volatility, Ken. And I got to say that, for all traders that have not seen the type of volatility that we're seeing now, these, people like yourself are the people that you should be following and queuing into. So, Ken, I want to thank you so much from the Trader Summit community for spending your time with us. And I want to thank you, the listeners at home, for spending your valuable time with Ken and myself. So, Ken, I can't wait to have you on the next event.
I look forward to it, and I'm going to sign up to see if I can win that phone.
All right. Sounds good. We'll talk to you soon.
Okay. Bye-bye.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.